First, again, thanks to the organizers for putting this conference together. Thanks for having me to present this paper. It really is a pleasure to present this paper at this kind of a conference, so I look forward to your feedback. So the paper is about financial crises, and I'm thinking specifically about events where one or more banks face difficulty rolling over their short-term liabilities and perhaps fail. Okay? And it's pretty natural to think of these events as occurring where some agents have some private benefits from creating risk of these kinds of events and perhaps don't bear all of the societal costs. So it's natural to think of these as inefficient outcomes. It's a straightforward way to think about that is coming from, say, implicit bailout guarantees. So it's not surprising that they may happen. This paper is about challenging this view. Okay? So my goal is to try to persuade you that there might be some, not just private values, but societal values to setting up a financial system that is subject to these kinds of events, where multiple banks will fail at the same time and face difficulty rolling over their debt. Okay? In that sense, I'm going to try to convince you financial crises may actually have some efficiency properties. So that's what this paper is about. So it's motivated by an old observation, which is banks and other financial institutions seem to rely very heavily on short-term debt to finance their assets. This is debt they have to kind of renew or repay in very short time horizons. And very naturally, this exposes them to rollover risk or possibly events that resemble bank runs. Okay, where they're inefficiently terminated or liquidated in some way. These financial crises are pervasive. We know from Reinhardt and Rogoff that they're a common occurrence in advanced economies. We think they're important events in understanding kind of large depressions in economic activity. Perhaps they played an important role in the most recent recession. So it leads very naturally to this question that some in this room have studied already, and I'm going to try to contribute to our understanding of, which is why do individual banks per se find it optimal to finance themselves in a fragile way where they're subject to these inefficient terminations? And more generally, why might it be optimal to have a system that is subject to these kinds of shocks? Okay, so that's what kind of the question I'm going after in this paper is. What am I going to do? I'm going to develop a theory of the optimal capital structure of banks. And kind of mechanically, I'm thinking about this as a large number of depositors have to finance an investment project, which I'll think of as a bank, and it'll be run by a bank manager or a banker. And these depositors are going to have to design compensation contracts to provide the banker with incentives. In some sense, I'll have to resolve some agency friction within this bank. The key results I'm going to try to show is that, one, the optimal capital structure is fragile. Specifically, there will be events, say when banks earn low returns, in which the bank will be inefficiently terminated or liquidated. Okay? I'm going to say these resemble a bank run. Okay? These depositors will be giving up future profits from continuing the operation, but they're going to try to find a way to commit to this kind of inefficiency. I'll show in particular that implementing this fragile capital structure necessarily requires contracts that resemble short-term debt. In that sense, I'll say short-term debt will be essential for a fragile capital structure. We'll see the role short-term debt will play. Those first three bullet points are really in a model with a single bank and a single group of depositors. And I'm going to enrich in this model to see what happens in a banking system with multiple banks. And I'm going to show you this model will imply systemic crises are optimal, in the sense that the economy, agents are all better off when all banks face difficulty at the same time. Let me give you a bit of the flavor of these results before getting to the model. So let's start by thinking about the mechanism with a single bank. And here I'm going to build off an idea that exists in important work by Calomiris and Kahn and Diamond Rajan, where bank runs or the threat of bank runs can be a useful disciplining device in resolving agency frictions. And I'm going to think about these depositors designing compensation schemes for the banker. And in a world where they have full commitment to long-term state contingent contracts, providing incentives will require them to commit to ex post inefficient liquidations. Okay, it will be optimal for them. This will be the optimal way for them to provide incentives to the banker. Okay? Now, of course, this introduces a natural time inconsistency. When they get to a date where they are trying to commit to this ex post inefficient liquidation, given the opportunity to renegotiate and rip up the contract, they would love to do so. And so in a world with limited commitment, the optimal contracts would have no ex post inefficiencies. But of course, they would provide worse incentives to the banker. So there's going to be a cost of limited commitment in this environment. Okay? What I'm going to argue, however, is when there's limited commitment, but there's an additional private information friction, depositors are subject to private discount factor shocks, they can actually attain their commitment outcomes. They can effectively get around the limited commitment constraint. in order to replicate commitment, to get around it, they'll have to use contracts that resemble short-term debt. And the idea here is they're going to create something that resembles a public good problem. At time 0, they're going to choose contracts such that at time 1, when they would want to renegotiate, the renegotiation problem will be very difficult. Short-term debt and private information will make it very hard for them, even if you allow them to coordinate, to renegotiate and roll over their debt. And that will let them get back to kind of the first bullet point, the commitment outcomes, where they're providing optimal incentives with these ex post inefficiencies. So the whole game is, how do we obtain commitment, and how does that translate to a world with multiple banks? What does that tell us about a financial system? Well, start by thinking about a world where returns are independent across banks. Okay? So you just take a one-bank model and you replicate it. You assume these banks are effectively completely separate. Well, what we'll see is short-term debt will no longer attain commitment outcomes. And the simple way to think about that is, if you have a rich bank and a poor bank because they received independent shocks, for commitment reasons, we would still like to liquidate the poor bank, the bank that earned low returns. But now the depositors of both banks can get together and kind of share the future returns and their current resources and make themselves better off by financing both of the banks. So with independent returns, they're no longer going to face the same renegotiation problems in a world of limited commitment. They'll be able to find a way to continue both banks. That's going to worsen incentives of the banker and yield worse outcomes. How can you get around this? Well, if returns are correlated across banks, and when one bank is doing poorly, the other bank's doing poorly as well. And now you might face the exact same hard renegotiation problem that you faced with a single bank. And that's what I'm going to argue. What this means is there will be a strict preference to live in an economy where returns across banks are perfectly correlated. So the optimal financial system will feature banks that earn perfectly correlated returns. When both banks earn high returns, the system looks fine, everything gets rolled over, we continue projects. When both banks earn low returns, or all banks earn low returns, we'll end up liquidating all of our banks. So systemic risk here is going to come from ex-ante investment choices, and it will be optimal. So the value to having this financial system subject to systemic crises comes from obtaining commitment. Commitment to provide optimal incentives to bank managers. Mechanically, you'll see it's going to be solved in a mechanism design framework. So a planner subject to the same constraints as the depositors, so to speak, won't be able to improve on these outcomes. And so we'll see a financial system with systemic crises will be efficient. So let's again start with a single bank model. Okay, single bank and a large group of depositors. And effectively what I'm going to try to show you are those three results. Under full commitment, we would like to liquidate the bank after low output is realized. With limited commitment, we'll face a time inconsistency problem. With limited commitment and private information, we can somehow get around that. Key ingredients in the model. So the first one I want you to pay attention to is it's a repeated moral hazard environment a la Holmstrom. Okay, so I'm going to think of a banker who has to exert some unobservable effort, and this effort will affect the distribution of future returns to the bank. Okay? Now, crucial to all this will be a constraint on what kinds of contracts we can write down, which will be limited commitment. And there will be a version of renegotiation proofness. And then lastly, I'm going to layer into this kind of classic moral hazard problem something that I think makes this look like a diamond Dybvig bank. So this project will be financed by a large group of depositors, each subject to idiosyncratic and private discount factor shocks that will affect how much they enjoy it in the future. And so this friction means kind of contracts will have to satisfy an incentive constraint which induces these depositors to report their types truthfully, their discount factor shocks truthfully. So those are the three key ingredients in this model. The model itself is fairly compact. Writing down contracts is where things get complicated. So let's try to focus on what are the key things in this model, and we'll talk about the results. So I have n+1 agents. I think that's the easiest way to think of this. I'm going to call the first n of them depositors, because I know at the end they'll look like short-term debt depositors instead of investors. And I'll call the n+1 a banker. Okay? It's a 3-period model, dates 0, 1, and 2, although I believe the model generalizes to kind of arbitrary number of periods. Now there's a production technology here. Investment in period 0 or 1 will require a fixed scale of resources, I. And we can talk afterwards if you're interested about the importance of that assumption. And investment will also require effort of the banker. So how does investment and effort turn into future output? Well, effort I'll denote E. I'm going to think of the banker just directly choosing a probability over future outcomes. So it can be low probability pi L or high probability pi H. Manager suffers, or the banker suffers disutility of effort denoted by Q. So I'll set the cost so to speak, of the high effort for the banker Q bar, and the cost of low effort I'll normalize to 0. And so let's start in time 0. If I resources are put into this production technology, and the banker exerts effort E0, then in period 1, output is I plus Y1, where Y1 is stochastic. Okay? And Y1 is high, YH, with probability E0, and it's 0 with probability 1 minus E0. So if the banker exerts high effort, we're likely to get high output. If the banker shirks, we're less likely to get high output. Okay? In this example, all the risk is over the net output. Okay? So the crucial thing that I'm going to want you to remember for later here is when we get low output, aggregate resources are still I. We have just enough to finance the project again if we choose to. If we want to reinvest in period 1, we have to put I in again and manager's effort E1. And then we get I plus a term which depends on period 1 output. For a moment, suppose that row were 0. So you're just getting I plus Z2. So it's exactly a repeated version of this game. What I'm doing is introducing a bit of persistence into these projects. So conditional on seeing high output, projects look a little bit better than conditional on seeing low output. And I'm introducing that persistence in a way that's not dependent on the previous effort level of the banker. This period 2 moral hazard problem, the only role it's playing is conditioning continuation utilities of the banker, nothing else. So if you like, you could almost ignore it, and I'll bring it back in where it matters. All of the action is going to be, how do we get the banker to exert high effort in period 0? And we're concerned about outcomes in period 1. Right? That's really where I want you to focus on this moral hazard problem. So just to finish wrapping up the model, now I'm going to think about this as having a large number of small depositors. So what do I mean small? Each of my depositors is initially endowed with I over n resources. So time 0, we'll need all of them to be willing to participate to finance this project. And they'll have nothing in periods 1 and 2. In terms of preferences, so this banker has linear preferences over consumption streams C0, C1, C2, and then the disutility of effort, again indexed by Q. And this banker discounts last period utility or consumption at rate beta. Okay? In terms of the depositors, they again have linear consumption. And in period 1, they'll learn their discount factor shock VI. So at the beginning of period 1, they'll learn how much they discount period 2 consumption. I'm going to assume these VIs are independent across depositors. They're distributed according to some distribution GI, which will be identical. The support is actually critical here. So they go from some range V lower bar to V upper bar. This most impatient depositor, V lower bar, so to speak, is the critical one. Okay? And what I'll assume is, with all the linearity, I have to pin down the timing of payments between the banker and the block of depositors, so to speak. So to pin that down, I'll just assume the banker is more impatient than the most impatient depositor with certainty. As I said, these discount factor shocks are private. For notation, I'll let V just be the vector of all discount factor shocks across the agents. And then there's a limited liability constraint. So for the depositors, this is important. That's what it means each depositor is small, right? They can't bring in outside resources. For the banker, this is also important because it's a limited liability constraint. This will also tell me something about continuation utility of the banker. That's the content of that assumption. So that's the model in 3 periods. Okay? Now I want to think about designing optimal compensation schemes for the banker and optimal payments between all of the depositors. I'm going to focus on direct mechanisms, and I want to think about an investment contract. So what's a long-term, so to speak, investment contract? It's just specifying recommended effort levels of the banker, transfers out of the remaining resources to the banker and all of the depositors, and a continuation rule. Do we continue the project in period 1? All as functions of the relevant history and realizations of the stochastic shocks Y. Okay? I've simplified this a bit relative to the paper just to condense on notation for the slides. But I'm going to think of PTI as a payment to depositor I. And what I'm going to say is they can only make payments in period 1 conditional on Y1. I'm thinking of this as they're paid before they realize their discount factor shocks. It will be a result the optimal contract has that feature. So I don't mind abstracting from being able to make payments after they learn their discount factor shocks. And then payments in period 2 to the depositors, again, as a function of the output history and the whole vector of discount factor shocks V if we continue the project. Okay? There are, of course, payments to the banker that are similar, and then a continuation rule. Here, it depends on the discount factors, but again, that's not critical in terms of the optimal long-term investment contract, and then recommended effort. So I want to work through the results in characterizing the optimal contract by slowly bringing in an additional friction. So I'm going to start with full commitment and full information of the depositor's types. Okay, and I'm going to think about the optimal contract as maximizing ex ante depositor's welfare subject to these constraints. So I just have resource constraints, non-negativity constraints, and the banker's incentive constraints. My goal is to show you why it's optimal to liquidate this project inefficiently after low output. This shows up in lots of optimal contracts. Optimal provision of ex ante incentives requires ex post inefficiencies. So I'm just going to give you the intuition here. What's the idea? As in most moral hazard problems, you want to create spread in utility of the banker in period 1, following high and low output, to provide the banker incentives to exert effort in period 0. You have two ways to create spread, right? You could just change the payment to the banker in period 1, or you could change the continuation utility to the banker in period 1, because it's a dynamic model. Now, if we continue the project in period 1, or the mechanism calls for continuation from 1 to 2, the banker has to get strictly positive utility in continuation. That's effectively the incentive rent the banker is getting from the combination of moral hazard and limited liability. So any continuation contract yields strictly positive continuation utility to the banker. What this means is that if we promise, or the mechanism promises to liquidate after low output's been realized, you can deprive the banker of that continuation utility. You could effectively create more spread. You get stricter punishments by promising or committing to liquidate the project. So that could be beneficial in relaxing the incentive constraint. That means you can pay the banker less after high output's been realized. But I'm going to assume this promise to liquidate is costly, in the sense that it's ex post inefficient. Knowing all of the depositor's discount factors, we could do strictly better off for the depositors and the banker by continuing the project. So this promise we have to somehow commit to do. When is it going to be optimal? When is this promise to liquidate relaxing incentives dominate the costs associated with foregone profits from the project? It's when moral hazard's severe. Okay? Now going forward, what happens in this state? We realize low output, the optimal contract says liquidate. We're paying out whatever's left, which was I in that state. We pay the banker nothing. We pay out I over n to each of my depositors. So it's as if we start period 1 now exactly like in period 0. But now they're all going to have these private discount factor shocks. They'll look different. So what happens if we add a limited enforcement constraint? Think of this as a constraint not to renegotiate the contract in period 1. Mechanically, after they learn their discount factors, let's let them renegotiate. So renegotiated contracts have to satisfy some constraints. There are resource constraints, non-negativity, and again, they have to provide the banker incentives to exert effort. And I'll say an investment contract is enforceable if all parties cannot gain from renegotiation. In the paper, this is a bit more subtle because they're richer sets of contracts, okay? But you can think about it here as just, is there a Pareto improvement or not? Not surprisingly, under an assumption that liquidations are ex post inefficient, the commitment outcome is not enforceable. We would just renegotiate it away. And so this is the classic time inconsistency problem. So you're strictly worse off in a world without commitment. Now, why does adding private information fix this somehow? Well, now I have additional constraints. I have to get these depositors to report their type truthfully. And here I'm just going to ask a simple question. Could I possibly enforce a liquidation contract? We see low output. Can we design a renegotiation contract that gets us all to participate and roll over our debt, so to speak? Well, what do renegotiation contracts have to satisfy? I'm picking an arbitrary one, X hat and P hat. So we're going to roll over with some probability X hat. I'll pay out, according to your reports of your type, P hat. These renegotiation contracts have to now satisfy the incentive constraints of the depositors. They have to Pareto improve, and they have to be resource feasible. So the total payments in period 2 have to be less than what we earn, net of what we pay the banker. What's the incentive constraint? Well, this top line is what a depositor gets in expectation if they report their type VI truthfully. The bottom line is what they get if they misreport and report a different discount factor, V hat. They're taking an expectation over the other depositors' truthful reports. And what do they get? Well, with probability X, we continue. The depositor gets P2, which he discounts at rate VI. With 1 minus X, he gets his status quo I over N. If he lies, what does he affect? He affects the probability we continue the project, and he affects the payment he receives. Okay? What's a Pareto improvement? It says this top line should just be bigger than or equal to I over N. So there's a constraint there that we have to satisfy the incentives, these Pareto improvement constraints, and the resource constraints in any renegotiated contract. And so now we get kind of to the heart of the paper in terms of the single bank model. We can resolve the time inconsistency problem in this setting. And so what you do is you say, suppose a depositor with the most impatient type is sufficiently impatient effectively. Then for n sufficiently large, all incentive feasible renegotiation contracts, the set of all possible renegotiation contracts we consider, converge to the set where the probability of continuation is going to 0. What it's saying is when n is large, it's difficult to construct mechanisms which satisfy the constraints, which get everyone to agree to put their I over n back in this project and roll over the bank. Mechanically, I'm applying results that come out of the theory on literature on public goods provision from Robb and Maleth and Postlethwaite. So this debt rollover problem is kind of mechanically looking like a public goods problem. It's not a sunspot rollover problem. I'm allowing them to coordinate, design the best renegotiation contract, and the outcome is they don't roll over anything as n gets large. The consequence of this is that they resolve the time inconsistency, right? We're saying all renegotiation contracts have don't roll over the project. So we can effectively commit to liquidate the project. So how does mechanically this result work? What's the economics? Well, I'm assuming that the most impatient type would not want to participate given a pro rata share. Suppose we just split up the returns to the bank in period 2 evenly. What I'm assuming is the most impatient type wouldn't put up their I over n for just a pro rata share. But I have to get this most impatient type to participate. So how do I do that? I have to give him a larger share of the future returns than everyone else. But now consider the incentives of patient types. By misreporting, underreporting their type, they can get a larger share of the future returns. There's a private benefit, which is really their incentive rent. What's the cost? Well, they might lower the probability we roll over. If we say we're all impatient, the mechanism isn't going to want us to roll over because it would be inefficient in that state. So there's a trade-off for a fixed n. You can get larger share of future returns, but you might lower the probability of rollover. Okay? Now, as n gets large, the probability your pivotal is converging to 0. Your effect on the probability of rollover is disappearing, but you can always capture this positive gain of lying and misreporting your type. So because the benefits don't go to 0, we can't construct renegotiation contracts. Okay? In that sense, when n is sufficiently large, liquidation is actually time consistent, but of course it's ex post inefficient by assumption. Under full information, we know this is a bad outcome. And that's why I'm going to say I think these events resemble runs or panics. A planner looking at this world or a government would say, I know I can make you all better off if we can just roll over. So it looks kind of crazy the way a sunspot type bank run does, but it's much more severe in terms of a coordination problem. And I say kind of introducing these ex post public goods problems are actually resolving the time inconsistency problem that we face under full information. This optimal contract, I think, really does resemble short-term debt. Okay? These depositors put up I over n in period 0. They get a right to effectively withdraw I over n in period 1. And if not enough of them agree, the bank is liquidated. Now in this talk, I didn't quite have time, but I consider a much richer contract space where we can choose when to give out these rights and when not to give out these rights. Okay? And I show that contracts that don't give depositors the right to demand I over n in period 1 don't commit them to liquidate the bank. Effectively, you have more slack participation constraints in the renegotiation problem. So you'd renegotiate away liquidation. So these contracts provide worse incentives than short-term debt does. And I think it's sensible to argue these contracts resemble long-term debt. And so that's a result in the paper. I think of them as just saying, we're going to leave all the money in the firm. No one has an individual right to withdraw something. We make a promise to liquidate, but when we get there, we know we can all be made better off. And we can design better contracts that do so. This is a sense in which short-term debt is not only sufficient, but also possibly necessary. Or at least contracts that give out the same rights as short-term debt are necessary. So far that's all about one bank. And I made these claims that crises are efficient. And crises, or in the model, you see all the value is how do we get commitment to provide optimal incentives. So let's see how this works in a model with multiple banks. And what I'm going to do is compare kind of two stark economies. So the first is going to be a replica of what we just saw. Think about two banks, 2 n depositors. Okay? And they're completely independent. Income across banks is uncorrelated. An individual's banker's effort only affects the returns to their own bank. Okay? And if you think about that economy for a minute, it's as if you have two separable problems. So all the commitment outcomes, you just want to liquidate any bank when they earn low output, are going to be the same. Okay? And I'm going to compare that to an outcome where returns are perfectly correlated. And I'm also going to increase the risk in returns. So I'm going to change two things, correlated risk across banks and riskier returns. And they both play an important role. Formally, what am I doing? When you have correlated risk and effort, you might be worried about moral hazard in teams type problems. I'm actually going to abstract away from all that with my production structure. So what I'm going to assume is the probability both banks realize the same income is 1 in this economy. So either both banks get high or both banks get low. I said I increase the risk. What I have in mind is low output for a single bank in the perfectly correlated economy will now be negative instead of 0. And high output will be higher than it was in our replica economy. Okay? And then what's the probability either bank gets high output? I'm going to assume it's the minimum of the efforts of the two bankers. So this Leontief production structure, so to speak, means a banker has to provide the same incentives, a planner has to provide the same incentives to an individual banker to both of them, because it has to get them both to exert effort. And what that means is under full commitment, a planner would be completely indifferent between these two cases. There's no incentive benefits from using the correlation structure in the production function to take advantage of the incentive constraints. What I'm going to argue is the limited commitment economy implies there's a strict preference for the correlated risky return economy. Agents are all better off when they live in the perfectly correlated world versus the independent world. Okay? And in that sense, that will imply the optimality of crises. What's the basic idea? Think about the independent case, and there are really two problems here. We're trying to enforce liquidation for either bank when they earn low returns. Okay? The first problem is kind of simple. Suppose both banks get low output. We want to liquidate both banks. Okay? What are aggregate resources when both banks earn low output? 2I. I have 2I resources. And what I'm going to claim is I can make at least n depositors better off by continuing one of the banks. What I'm going to do effectively is take the n most patient depositors and say, give me enough resources to roll over one bank. So I'm going to coordinate depositors into one of the banks. Okay? When can I do that? Well, as long as the median depositor is happy to take a pro rata share for one bank. Then for n sufficiently large, if I just call out pro rata shares, I'll get n people to sign on. So if you're a banker contemplating, should I exert high or low effort? If you exert low effort, you're likely to get low output. And the other banker, you assume will exert high effort, is likely to get high output. But if they get low output, that's OK. With probability of half, they're going to coordinate on you and roll you over. So the incentives are stricter there. Okay? Increasing the riskiness of returns can fix that. Suppose when they both earn low output, there's only I resources left. Well, if there are only I resources, I need all 2n depositors to finance even a single bank. And then the public goods problems I described shows up again. So we can't roll over even a single bank if I increase the risk. And now I should apologize to Doug. This is preliminary and not in the paper. It's something I've been working on. So, and I'm going to actually state this as a preliminary result. So what happens when there's high and low output? So say bank A earns high returns and bank B earns low returns. Well, I argue now that 2n depositors, all of our depositors, can be made better off, even with private information, by continuing both banks. And the idea now is you both have more resources because you've got the high amount of resources from bank A that did well, although you have low resources from bank B. So you can combine all of those, but you can also share the future returns. It's as if you can aggregate these banks. And if there's enough surplus, and in some sense the average depositor isn't very different from the most patient one, that will Pareto improve. So even with these constraints, if we have independent returns, this commitment to liquidate can be renegotiated away. Correlation can resolve that time inconsistency. We just eliminate those states of the world by having them take ex ante correlated risk. And so I state this as a proposition that when returns are perfectly correlated and sufficiently risky, commitment outcomes can once again be attained with short-term debt. Welfare is strictly higher in the case of perfectly correlated banks. I say that because obviously there's no real insurance motive here. So that suggests it's robust to introducing some insurance motive. And just to be clear, kind of the equilibrium outcome in that world of the optimal contract says when all banks are in low returns, they're all liquidated. So this optimal financial system features, quote unquote, systemic crises. And so let me conclude. In this paper, I think I've developed a model and conditions under which a fragile capital structure of banks is not only privately but socially optimal. Along the equilibrium path, bank runs actually do occur along the equilibrium path of the optimal contract. I argue short-term debt is kind of essential to allowing commitment to these ex post inefficient runs, as I've called them, and that long-term debtor equity may not attain that same level. And lastly, the same limited commitment frictions imply correlated risky outcomes in the financial sector, or a financial sector subject to systemic crises may be efficient. Thank you.
Thanks very much for having me discuss this paper. I truly enjoyed reading it. This is an issue I've thought a lot about. I'm a little bit biased toward the idea that these things are a commitment device. I had never thought that systemic crises were a good thing before I read this paper, and we'll see what we think at the end. Jury's still out. So this paper asks a bunch of questions. So are financial crises part of an ex-ante optimum? So like Franklin Allen and Douglas Gale have a paper that argues something like this. This goes a bit further. Is short-term debt a commitment device? I'm sort of on board for that one. And through a slightly different mechanism, I'll talk about how the stuff that I do and that I do with Raghu is a bit different. And these are the last, this is the totally new part of the paper. Our system-wide systemic crisis is important to implement an efficient allocation, and our highly correlated risks leading to systemic white crisis a good thing ex ante. So we'll take a while, take till the very end of my discussion to talk about exactly how that gets into the model, because I think we have to understand what's going on along the way first. So Ariel's answer is yes to all of the questions. These are all good things. This is why we use short-term debt and things like that. So this is in a model where sort of the only role that short-term debt has and financial crises have is as this commitment device to sort of provide a punishment. And they sort of, nothing really too bad about them. They just sort of provide an efficient punishment. And financial crises are nothing we should, you know, they're ex post inefficient, but they're not that bad. So, you know, long-term debt or an equity because it doesn't, we have this unanimous consent thing that happens simultaneously. You can sort of allow some time for renegotiation. They're prone to do ex post efficient things, which we don't like. So once you're in the world where you do things that are ex post efficient, that takes commitment away, and the time consistency of the punishment goes away, and then, you know, effort incentives are reduced. So this is obviously related to the stuff, you know, that I've done on runs as a commitment device, but it also strikes me as really close to a paper that essentially makes the same point in a different setting. It's a paper by Chari and Kehoe, Bailouts, Time Consistency, and Optimal Regulation. So it's not exactly the same model. They have a model there where if you write private contracts, it's sort of like a Townsend costly state verification model that you can essentially commit to have the court inefficiently intervene and verify the state, and then give essentially zero continuation to the agent. And that private contract, which doesn't have to be short-term in their model, is what short-term debt is here. And then they have this thing called the government, who likes to do bailouts, and they can't stand things that are ex post inefficient, so they step, because of limited commitment at the government level, they step in and provide the bailout. And so, you know, this model is almost the same model, but it has different names. We'll come back to talk about this when we think about the possibility there might be a government in this model. It could cause some problems for this story. So the basic idea of the model, I'll just go through it. You know, you did a very nice job presenting it, but I'll go through it again just so I can focus the parts that I think are quite important here. So we have a standard moral hazard effort problem, and the optimal contract is to impose a zero payoff after poor performance in a two-state, three-date model. So we need inefficient liquidation after poor performance in this middle state, because if you're going to keep the agent around for incentive purposes, you have to give him a rent in that continuation. So even though, you know, you'd like to sort of ex post keep him around, if he knows he's going to get that rent, punishment is like not so bad because he keeps getting, you know, he doesn't get his $10 million bonus, but he gets his $5 million bonus. So early liquidation, again, at the middle date is not in the ex post interest of the principals, the lenders, requires some commitment. So how does this mechanism work? So you write a contract that requires unanimous consent of all of the lenders. So that's a little bit like this law we have on bonds called the Federal Trust Indenture Act that says if you're going to change principal interest or maturity on a bond, you do need unanimous consent. So that's not a crazy thing. And the lenders are ex post heterogeneous in their impatience. So some people get preference shock, some people don't, and they vary in their intensity. So the ability to sort of misreport that you're highly, impatient and want your money today is the way we get the commitment in here. And the way it actually works here is through something I might call like an aggregate liquidity shortage. There's nobody around who has funds to inject that are sort of outside the original set of depositors. So there's no specificity of assets or relationships. You can just somehow get somebody to inject the money to implement something that's ex post efficient. You would be able to do it. And the whole goal of designing the contracts is to make sure there's nobody out there on the outside who's sufficiently patient who can inject this money. So I think that's the particular reason that systemic financial crises are good, because like everybody's broke then, so you have to liquidate. So again, unanimous consent and this assumption that impatience is private information leads to a problem that's very standard in sort of the workout of bankruptcy, workout of debt default outside of bankruptcy, the thing called the holdout problem, that the people who hold out sometimes do better than the people who make concessions. So if we can sort of if we can reward people for holding out, then they'll hold out. So holding out here is essentially misreporting your impatience as high. And it's important, there are actually no runs in this paper. This is just, we simultaneously all report our impatience, and then if enough people report that they're impatient, we go ahead and liquidate. So there's no so the way like Raghu and I and other people implement runs or implement the commitment of short-term debt is through something where there's some either lottery simultaneous, non-simultaneous, either a lottery or literal real-time first come, first serve, which sort of rewards people who report that they want to get paid, and there are multiple equilibria, there are things like that. All kinds of bad stuff happens sometimes. Here, nothing really bad happens. There's really no rollover risk. There's something which is like rollover risk. And so this sort of has some of the good, the good but not the bad side of commitment here. So I said this is there's a paper called, well, I can't remember, efficient financial crises or optimal. Like, this is whatever one yours isn't, the other one is. Yours is optimal, theirs is efficient, but first, second welfare thing doesn't really matter. And so what they basically had this idea is nobody knows when you're supposed to close the bank down. So it's a similar kind of thing. We want to commit to close the bank down. Nobody knows. It's not verifiable. But if you set up a runnable deposit, when it's time to close the bank, guys will run to the bank, and then we'll find out it's time to close them down. So I believe this story more than I believe that story. But I think it's still, there is something good about these runs, these crises, in that something bad happens to the bank, and we sort of need to know something. We learn something we wouldn't learn otherwise. So the basics of the model here, debt contracts provide optimal incentives. This is sort of a non-robust part of the model because there are two realizations of the state of nature. So we'll see if there are more than two realizations, you don't get debt contracts. And there's a lot of evidence in the model, in the paper, comparing the capital structure of firms with banks. So firms don't issue much, corporations don't issue much short-term debt, banks do. So we'll see whether this model, if it can explain that or not. I don't think it can. So the results are interesting. Let me just sort of describe like the difference. I already described a little bit. So that there's two sets of papers of mine and ours that do this. So in the stuff with Raghu, effectively, loans are sort of hard to collect financial assets. There's an ex post holdup problem because only the banker can collect the asset. So you need to commit the banker not to renegotiate down the loan. So then the threat of a run, ours first come, first serve, but we could do it exactly the way you did it, commits the banker not to do that. Then I have this paper in 2004, which sort of takes that mechanism to a corporate setting. And then there it's not liquidation, but there's a commitment device called a court, that if you go to court and say, they defaulted on my contract, now I have the right to liquidate, the court is a commitment device. The commitment problem is getting the depositors to report to the court that now is the time they want liquidation. And the first come, first serve element of this thing basically builds in commitment to do that. So that in this sense, neither of these things explicitly do this as a mechanism design problem. We build in this institutional thing called a court here, or called first come, first serve, which is present in both of them. And that becomes a little bit messy here. Here, this is very clean. There are no distracting details. Standard effort problem, none of this stuff about banks or loan specificity. So we can sort of see in a very clean basis that this is really what this stuff is about. It's trying to commit to prevent something. Here it's shirking followed by renegotiation continuation. So it's interesting, different take on this kind of stuff. So let me sort of talk about this. I can think about this from 2 points of view. One, from the financial intermediation banking literature point of view, the banking set of ideas, and second, from corporate finance. From the point of view of banking, this really isn't a banking model because there are no firms in this, so unless you think it's hard to be a banker and easier to be an entrepreneur, you don't want to think, there's an effort problem here. So I don't really think that this does much to explain the difference. But in fact, I would treat this as saying, if you look at the evidence that this doesn't seem to apply to firms, unless you're thinking, well, banks are well diversified, so they're the only guys could have, just systemic risk in them, you could say, well, we should have conglomerates then, or something like that. So really, what's missing in this, and I think it would be a nice way to think about if you're really going to take this seriously about system-wide financial crises, is thinking about the difference between firms and banks. And then from just as a minor little detail, from the corporate finance theory point of view, debt contracts are not the optimal way to provide incentive to a risk-neutral agent. Basically, what's the general point? You want to punish low outcomes and reward high outcomes. So like Innes has this nice paper that says, no, that's not debt contracts. You give everything to the principal for low outcomes, and you give everything to the agent for high outcomes. And that has a jump in it, and then it makes the principal's contract not monotone because of the jump. So that's not a big deal. But in any case, that in some sense, the way this is set up to deliver to deliver short-term debt as opposed to short-term weird stuff, requires two outcomes. So let's get back to the key thing here. What's really giving us the commitment here? This is the key element of the model. So it's what I'd call this aggregate liquidity shortage, the inability for any outsider to inject funds to buy assets of the bank or deposit in the bank to remove the need for unanimous consent to continue in the bad state. So this, in a certain sense, requires this is the only bank in the world, or this is the whole financial system. So that's sort of the reason that this thing pushes to start thinking about system-wide crises. If you had like one particular bank failing, one tiny little bank failing, probably there'd be plenty of patient people out there who'd be willing to pick up these assets at at or below their fair market value. If it's efficient to continue them, you would continue them here. So whether this sort of aggregate budget constraint is the right way to motivate this stuff, I'm a little suspicious. So the way this thing works, like if all banks are in trouble and the losses are huge, that's an important thing here, and the losses are huge, we'll see how that's coming in. There's nobody else to lend to any bank, and this provides commitment. Perfectly correlated risks are good because it makes it more likely we get into this circumstance where we can't afford to save even one bank. And that's then if we can commit banks to take actions that are either all good or they're all like this, that will prevent shirking. If only a few banks were in trouble, obviously this wouldn't happen. Okay, so now we'll talk about the details of how it gets modeled, but now I think we're really back to this Chari-Kehoe paper. So if it's really the case that all the banks in the world and everybody's in deep trouble, that's exactly the time you would think the government's going to step in. So it's not quite present in this model because there's like nothing particularly bad that everybody's in trouble versus one guy in trouble. We're just doing this, everybody's risk neutral here and things like that. We're just doing this inefficient liquidation more times over. And it's all sort of linear utility, so if we do it once, we do it 2 times, it's like twice as bad if we do it 2 times. So if you sort of believe that maybe it's actually not great to liquidate the entire financial system as a whole, and there might be bigger costs, you know, in that sense if you didn't have a financial system at all, then it's not even obvious to me that if everything else were right, that if you had a government, you could commit to do this. Because I think this would exactly be when the government would come in. So now we're back sort of in the Chari-Kehoe thing. What kind of stuff could you think you could do to commit the government to not intervene in this case? So things might play out differently. So, I mean, this sort of says, like, you know, Ben Bernanke was a complete fool, and if we just, in lender of last resort is a very bad idea, because systemic crises are exactly what we want to make sure that we have. Now, there are these, I mean, this is not like nobody thinks like this, right? This is like, there are people who say, well, the only reason we have so many financial crises is because of anticipated bailouts. You know, and the reason that Lehman did these things is because they knew that they were going to get bailed out. Well, clearly they didn't get bailed out, so they, you know, somewhat made a mistake there. But, you know, so this would be a micro foundation for this view that financial crises and bad stuff are caused by anticipated bailouts. And if we just knew the punishment would be so bad, guys would work hard and this wouldn't happen very often. Okay, last comment I have, and this is, again, this is where I'd like to see more in this paper, because I mean, I don't quite believe this result, but I think it's definitely worth thinking. It's definitely empirically possibly true, and it's a really interesting idea. But the way that the result that the systemic crisis is sort of good in this model, I'm less than happy with. So what's the basic idea? Suppose we only have one of two projects doing well, then we sort of randomly going to continue one of them. So that's not good. And when they both do poorly, in the original setup of the model, you know, then if both do poorly, that's fine. We continue one of them. But if losses were bigger, then depositors are let both fail. So it's not, when we're going to more correlated risks and less correlated risk, we're not just changing the correlation. We're saying if you choose the more correlated risk, the loss per project is actually bigger. And then if we can get it so the maximum loss per project is so big that we can't afford to continue even one of them, then we get this commitment to let the stuff go on. So I can imagine situations when that's true, when that's not true. And I'm not positive that that's the you know, if that's what it takes, I'm not sure I completely believe this, and I'm not positive that's what you know, I'm pretty sure that if you tweak the model a little bit, just having lots of lots of projects that would otherwise be of the same scale of losses, if you just made them all go down at the same time, I could believe it would be very, very hard to refinance them all. So I don't think you really need this. So there's this part of the paper, which seems to be like the punchline of the paper, all of a sudden gets way less general than everything else. The other thing is we can just sort of think about this in terms of implementation. The banks would each prefer to have independent projects. So if they happen to fail, if they happen to do poorly, they get refinanced and don't get punished. So this is exactly the opposite of the stuff that's in the interest rate, illiquidity interest rate policy paper of Ragu's and mine, or in the paper of Farhi and Tirole, that are both sort of too many to fail papers. So in both of those papers, if a lot of guys get in trouble, then like in the Chari-Kehoe paper, then you get bailed out. So therefore, they want to take correlated risks. This is sort of the opposite, because if everybody gets in trouble, you're not going to get bailed out, then you want to take independent risks. So if you also, in addition to had an effort choice, you had a choice, you could privately choose your correlation, this wouldn't decentralize, because the last thing you want to do is be in trouble when it's you get punished to get in trouble. So I think that this point could be addressed as well. So overall, I think, you know, a bunch of very interesting and new ideas in here. Without further development or thinking about the type of data you'd have to look at to see if these were relevant or not, I'm not sure I believe them, but I think very creative, very new idea, and I enjoyed talking about it. Thank you.
So you raised a bunch of, I think, interesting questions that I'd like to go through a few of them, I think. I think the main point of the systemic crises issue is understanding it's really a response to a lot of people who view this all as a result of bad government policy, who think if we could just somehow commit the government not to act, we wouldn't see these outcomes. Which even just thinking about banking history seems, it's hard to think in many earlier episodes they were all predicting implicit bailouts of the national government, and we still saw systemic crises. So I think it's providing some, the efficiency properties here, do I take them that seriously? The same way you were saying, it's hard to say, right? Because there are no external costs to these crises, nothing else is going on, as you were saying. There are losses, they're giving up future value. So it's not like it's free to shut down these banks, and those costs can be significant. You still choose them as long as these events are rare enough. So I'm hesitant to say the losses are peanuts. But it also suggests there are forces pushing these banks to do this independent of bad policy in the view of some people. And I think that's relevant here, that understanding at least the banking system's incentives to go in this direction. In terms of, this last point's a great one. It's something I'm thinking about. What would they do in an equilibrium game where they choose their projects, okay? You're absolutely right. I just said which mechanism is better. And I agree, depending on how the modeling goes, I'm fairly certain you could have a model where they choose the correlated risks also. It's not obvious I agree if they can privately choose these projects and do, then all bets are off. But I'm sure if these project selection, correlated, not correlated, are observable, then you can write down a kind of standard game form where N equilibrium is they choose the correlated risk outcome. So I'm confident that could be expanded on, but you're right. It's something I'm starting to work on kind of as these results are coming in and I'm figuring it out. So thanks for that suggestion. In terms of debt being sensitive to just two states or not, you're absolutely right. And that's a point taken. As you can see, the model's kind of a complicated mess already. And so the idea that maybe it's literally debt is probably too severe. And as you said, the idea is to allocate rights to ensure commitment. How you do that is going to be sensitive to the environment. I agree. In terms of the aggregate liquidity shortage, so in some sense, that was the whole purpose of writing a model with multiple banks, right? And that led to these ideas. I thought the first pass you think about that is, well, why don't I just have Warren Buffett in the model in period 1? I'll have someone with deep pockets. And this comes back to the assumption of fixed scale in terms of the project, right? The question is, how many people do you have to bring in, and how patient are they? And so, if you approximate this fixed scale with a convex production function, then it's a horse race between kind of how fast the returns are going up and how many impatient types you have to pull in. So in that sense, you could model it that way. The results would go through with just different assumptions in terms of, do you need the most impatient person not to value it, or the median person? You get into the order statistics of it, and as a theoretical point, I think it's robust in that sense, but it becomes messier. So I'm not quite sure what you get. I do think it would be interesting if you thought about the data of kind of how patient are people, what's their wealth in these different events. I think that could help think about what's driving these crises. Do I really believe there's a loss in wealth in those states? So I think that's a useful suggestion on those margins. And then the last thing I'll talk about, just because I think all the Chari-Kehoe stuff is about when you internalize the effects of policy, what happens in the private sector. And clearly, there's no role for policy here. I'm not harping on that almost in some sense because that's a point you've made very strongly, that deposit insurance may be a bad idea in these models where you're trying to get commitment to discipline. But I think the point you raised, which was in earlier versions of the paper and is largely missing, this difference between financial and non-financial firms. It's one of the most striking facts in the data of how different they are. I've done some more work to try to tease out, because just looking at short-term versus long-term is a bit crude, because you have to worry about deposit insurance and how much is uninsured short-term. But you still see these big differences. And you're absolutely right. This model at face value just doesn't speak to those differences. Except on one margin, really, which is N. Kind of how many people do you need to finance a project? So clearly, none of this is going to work if you have a small firm that one person can always finance. So at a minimum, it's going to tell you something that these effects are important for large-size firms. Now, are those banks or firms? I think that's an interesting question. Earlier versions of this paper tried to take a tack similar to some of your work and understand, is the moral hazard problem different for banks versus firms? Is there a sense in which we should think of it as being more severe for banks and less severe for firms? And there are ways you can write that in the model, and it comes right out. That do you want to commit to these costly liquidations ex post? It depends on how much you're saving on the incentive rent and how much the ex post losses are. Maybe that points a way for data to think about that, of is there a way to try to tease that out? I had told some stories, like I said, in very earlier versions of the model and modeled it, but I wasn't convinced, so I scrapped it. Because I really think that's not what this model is going to help us understand. But I think it's a challenge for a lot of this literature, because they are so different on these margins. It's not, You're not going after the same variation in maturity that you see for corporate firms. It's like two starkly different sets of firms that are in very different businesses. And I think it's kind of an avenue for future work to try to figure that out, because I think it's important to understand why maybe these moral hazard problems are more severe if we believe this story. But again, thanks for your comments, man. It's very useful.
Australia, I think the headquarters is very interesting, and I thought that you can make the choice of putting a correlated risk and what's called a republic. You choose correlated risk as like saying, please punish me in case I misbehave, right? And then it gives better terms in the first period. I guess what's happening in the new world out there, the bankers don't really get better terms, right? All the benefits kind of included in the depositors, but if you would imagine some of them borrow more cheaply by choosing the correlated risk, and that results in your return. But would you, I agree with that, would you be interesting to know, what conditions do you get more correlation, and what conditions do you get more intended? Because that's certainly something that makes sense. There's another question about it.
I just had a good point that touches on some of the things that you were mentioning about, this being more applicable for large entities and the fact that the crisis being costly exposed, providing incentive, etc. I mean, I guess that's related to many of the things you say here, and to many of the papers that were discussed is the case of countries. That also have short-term that are exposed to crisis. And in the early 2000s, there was this notion of building a bankruptcy mechanism for countries that would exactly step in and stop the liquidation, if you will, and reduce the cost of crisis. And many countries complained, and Mexico among them, saying, look, we don't want this. Precisely because they were afraid that this would eliminate incentives and make it more expensive for them to borrow.
There's one more question.
So suppose you took your sort of model seriously, like how do you propose to get the banks to take correlated projects? Like, what's the mechanism that's
in a decentralized?
Yeah. So how would you sort of get that?
Sure. So I'll just talk to that last point in Harold's question. What do I have in mind going on here? Are banks investing in the housing stock, or are they investing in corporate equity? Right? It's kind of observable what they're investing in, where you can see the assets they're holding. And so the idea is if depositors can condition their loans on the kinds of assets banks are holding, then they can provide incentives in the way Harold had in mind in terms of the loans, kind of the rate on the loans will actually be different, right? They'll get better terms, even if in this outcome they're getting driven down to their outside options, right? But you could change kind of exactly which point on the Pareto frontier you're selecting. You're not going to change the feature of the contract. So to the extent you can see their assets, which is a question, I think it is possible to assume these things are observable.
You see very aggregated statistic to sort of go from there to all the moments, including correlation.
But that I agree with. But you can see in the lens of a model that if it's observable, the types of investment you're doing, then you'd think you'd be able to, so like I said, this is a conjecture because I haven't written it down, but you think you'd be able to get them to condition their loans on that. It's the same thing here. The simplest way of modeling it, which I have in the paper of short-term debt, when I do a decentralization, it's non-contingent short-term debt implements the optimal contract, where it's just a banker issuing short-term debt claims. I'm effectively assuming away sunspot-like events. And if you just write the crudest version of the model, you're still stuck with these sunspots. So there again, you're going to add some kind of escrow account where it sits in escrow until enough people put in, then it goes, just like a Kickstarter campaign, I guess. So that's what I'm saying. I think you can write down a game form that's going to yield these outcomes. You're going to have to, I know it'll work, I think, if you assume these investments are observable. If they're private, all bets are off. I mean, that's an interesting problem to think about. When you're worried about these ex post incentives plus their private incentives to choose a different margin of moral hazard, I think that's a challenge, but it's interesting.
It seems like you want lots of diversification, so all they have is the aggregate shocks left. Versus you want to all be very sort of the opposite of like the network stuff, and sort of nothing like the Volcker rule or something like that.
So, and in terms of countries, I mean, yes, but I'm hesitant to go there because that's not my area of expertise in terms of the details of how well I think this should apply or not. But I think it's an interesting question of, can you use variation in maturities, either in terms of aggregates or across countries, to think about that.
Mentioning because that was a clear case where the interested party,
right,
in a sense,
vetoed
was voicing this, the fact that the crisis has.
I was thinking of the same, that the thing that is weird is that in the 80s, you actually have, because I think the interpretation there will be where you have defaults or not after, but then you have in the 80s that then the loans were syndicated with few banks, and then you have defaults in the 80s. And then you have that then bonds with actually pretty strong clauses, like pari passu and acceleration clauses,
and then you had default. So it's sort of like, I was just thinking the same, because there it looked like a natural comparative study, and then maybe it's sort of,
You're saying that we saw default
either way,
in all types of debt.
either way, with the concentrated with very few banks, and then
That's true, but
it's true that probably was more when they were concentrated, was more, it happened more at the same time.
Exactly.
It was all the countries kind of close
There was a
together.
lot of reprofiling back then.
Yes.
Because the banks were basically kind of groups.
That sounds like a great topic for viewers, so let's close it off here. So,
Thanks.